Okay. So this is a case study predominantly on the capital gains tax small business concessions. We've spoken about this particular client in the past where they are running two businesses within the one company, rolled a business out, and then sold shares in that business. Okay. So I just want to go back to the CGT concessions and just point out where you need to take care. So who can tell me what the eligibility criteria is for the capital gains tax small business concessions?
You mean the CGT event?
Yep, great. So you need an event.
There's the 15-year or whatever.
Yeah, that's a little bit later on. These are just the basic concessions. So even to start thinking about using these small business concessions.
Be a small business.
Yep. Or
Yeah, that's it.
of what, Steve?
Less than 5.
6 million? Okay, so what's the definition of a small business entity?
Less than 2.
And?
Carry on.
Good. And? See this coaching game, this piece of cake?
And is not a question.
Yes, it is. And question mark. What in addition to turning over less than 2 million and running a business?
If any other teams want to get up the front
need
and
to-
demonstrate anything, feel free.
Do you need to consider? What's the turnover? What's the definition of turnover?
Oh, actual budget or forecast.
That's right, but then also of
Of
your
their affiliates.
affiliates and connected entities. All right, great. We missed out a key one, so there was an event. We sold shares. What has to happen before you're thinking of it?
Game.
You've made a gain. Great. The third then is yes, you're either a small business or you're satisfied with 6 million. What do you need to be doing? What do you need to have had happen? Like if I sold my BHP shares, would I be thinking about small business concessions?
Then to be active.
Active? Beautiful. And what's the definition of an active asset, please? Someone from the red team?
Blue team?
It's used to process it and carrying on that business.
Yeah, that's right. It's connected to the use of a business. It's not a passive portfolio of shares. Okay. That said, like a passive building, a commercial building can be an active asset if it's used by a connected business. Okay. And what's the fifth one? And it's relevant where? So if I actually sold this business, do I need to think of this particular one?
So it's in relation to sale of shares we use.
Yep, that's right. So where you're selling shares or units, what comes next?
Is it the CGT concessions stakeholder?
Yep. Yep. You are a CGT concession stakeholder, or if you're a trust or a company, at least 90% of the people who have an interest in you are CGT concession stakeholders, okay? So if you're a company or a trust, more than 90% of people, so it's called the small business participation percentage, are held by CGT concession stakeholders. So what's the definition of a CGT concession stakeholder? Come on, Ray. Just yell
Is it
something.
They have an interest in it.
Yeah?
Some
Some interest. What sort of interest, Scott?
Like financial,
Yeah.
as in like they're a unit holder in
Mm-hmm.
the trust.
You guys are biting your tongue? No, I can't remember.
20.
20%. So what's significant about 20%, Steve?
Control.
No.
No, I know, it's like... No.
It depends what the entity is as to what the 20% the first use of for it costs, which makes it of income or capital. And for a company, with 20%.
So what's that 20% holder called?
Significant.
That's it. Significant what?
Individual.
That's it. So if you're a significant individual, as in someone who holds more than 20% of a direct or indirect interest, you're a CGT concession stakeholder. What's the other way you can be a CGT concession stakeholder?
If you're the spouse of the city person.
That's it. With a interest of what, Jen? Of Marie? Interest of what? Greater than?
Less than 20%.
Or a spouse of a significant individual with greater than a zero interest. Okay? So if dad owns 99% of a company and mum owns 1%, she will still be a significant individual because she's the spouse of a significant individual, and she has a greater interest of more than zero.
So does that just mean that she doesn't have to have the 20% herself?
Yeah, that's right. That's right. Which is where you get to when you're thinking of companies or trusts, you can have up to 8 significant individuals. Okay, so you have 4 20%ers and then the spouses of. Good. So why is this relevant? So what happened here? Yes, we rolled the business out and we have shares and we've gone and sold the share. So we know the event has happened, we sold shares, we made a gain, we passed the 6 million test because our business turned over more than 2 million. It's an active asset. So we sold shares. What's the extra consideration to be given when you're selling shares and saying they're active assets? What do you need to do?
No.
No.
You need control.
No. To determine if it's active or not, what do you need to do?
Would the share of...
So you need to look through, and look inside here and ask, are 80% or more of the assets of this company active? Okay. So when you're selling shares, you need to take that extra step when you're thinking of active assets. Okay. So look through. And the answer was yes. Where we're selling shares, you or people in you have greater than 90% small business participation percentage. So significant individuals or CGT concession stakeholders can only ever be individuals. Okay. So for us, we now need to, it's you, so the company, we need to look and say, right, do we have more than 90% of, or are more than 90% of the interests of this company held by CGT concession stakeholders? Because if not, then we haven't passed the criteria, okay? So what does that mean we need to think of or consider? Where this trust owns 50% and this trust owns 50%. 2 different families.
You need to consider who the trust distributes to.
Yes. So, can you give me an example, Jess, of maybe not you? Can someone give me an example?
Fine.
Sorry. Can someone give me an example of where a distribution that wouldn't help the cause here? Or maybe I'll do it this way.
Could the trust distribute to companies?
Yes?
And if you had a company that owned 95%, was distributed 95%, and an individual that was only distributed 5%, they wouldn't satisfy that they had significant individuals holding more than whatever the 80% or whatever the cutoff
Maybe. What's the next question? If we did do that, 5% and
Oh,
95%,
then
what do
you'd
you
have
need to ask?
to look at the shareholders of the company, and
Correct.
that's just
So-
stupid. So
No, absolutely not. Like, if that
Yeah.
person owned 100%, then you'd be fine.
Yep.
Okay? Even if they own half, you'd be fine.
Yep.
For some lesser percentage, but that's right, so you'd need to look through in that sense. Good. So is everyone, so let's say we have one individual over here that gets 100% of the distribution. What percentage of CGT concession stakeholders have we got up here at that point in time?
50.
50%. So there's 50%. What do we need? 90. So what are our options here?
Greater than 80.
Yep. So if 80% goes to one individual, 80% by 50% is 40%, we're in. What else can we do?
Mum and dad.
So what would the percentages be there, Steve? What's the minimum percentage you would need if you had a mum and dad?
20.
Yep. So what percentage of the trust distribution would you need?
40.
Yep. 40. So you then have two significant individuals, okay, and the balance can go somewhere else. So that's the takeaway message of this, particularly where you have arm's length parties here. The actions of one party could screw the other. Okay, so a good conversation needs to be had about the trust distributions to ensure the eligibility.